For years, businesses were obsessed with growth, grow faster, expand aggressively, open new locations, hire more employees, launch more products, increase revenue every quarter. Growth became the ultimate business goal. Wall Street rewarded it, investors chased it, startups were built around it, and for a long time, companies believed constant expansion was the safest way to survive. But now something is changing across the business world. Many companies are suddenly acting far more cautious. Businesses are talking less about aggressive expansion and more about efficiency, resilience, and stability. And underneath today's economy, a hidden battle is taking place between growth and stability. Because modern companies are realizing something uncomfortable. Fast growth can also create enormous risks, especially during uncertain economic times. For years, cheap money helped fuel aggressive business expansion. Interest rates stayed low. Investors poured money into startups. Companies borrowed heavily. Growth became easier to finance. Businesses could focus on expansion without worrying too much about profitability because capital remained widely available. That environment encouraged risk-taking everywhere. Tech companies hired aggressively, retailers expanded rapidly, startups chased scale at almost any cost. The strategy was simple: grow first, worry about efficiency later. But the economic environment changed dramatically. Interest rates rose, inflation increased, investors became more cautious, borrowing money became more expensive, and suddenly many businesses realized they had built operations heavily dependent on constant growth. That created pressure across nearly every industry. Businesses started reevaluating priorities. Instead of asking, "How fast can we grow?" companies increasingly began asking, "How stable are we if growth slows down?" That shift is changing corporate strategy everywhere. One major example is hiring. For years, many companies aggressively expanded workforces during strong economic periods, especially in technology. Businesses hired rapidly because they assumed growth would continue indefinitely. But when economic uncertainty increased, many companies realized they had expanded too quickly. Layoffs followed, hiring slowed, and businesses became much more careful about long-term labor costs. This wasn't only about reducing expenses, it reflected a much larger shift toward stability. Companies started prioritizing flexibility over maximum expansion, and investors began rewarding efficiency more heavily than pure growth. That's a major change from previous years. For a long time, markets often rewarded companies simply for growing quickly. Even unprofitable businesses could attract massive valuations if investors believed future growth would remain strong. But today, investors pay far closer attention to profitability, margins, debt levels, and cash flow. Efficiency matters more, sustainability matters more, and businesses are adapting accordingly. This hidden battle between growth and stability is also reshaping how companies spend money. Businesses are becoming more selective about expansion projects, new offices, large acquisitions, aggressive hiring, risky investments. Companies increasingly want stronger justification before committing large amounts of capital. Because uncertainty changes how businesses think. Economic instability, geopolitical tensions, inflation, and rapid technology shifts have made executives more cautious about overextending themselves. And many companies now believe surviving uncertainty may be more important than maximizing short-term growth. Technology companies are experiencing this tension heavily right now. Artificial intelligence has created enormous excitement and investment opportunities, but AI infrastructure is also extremely expensive. Building data centers, buying chips, hiring engineers, and training models requires billions of dollars. So businesses face difficult decisions. How aggressively should they invest? How quickly should they scale? How much risk is acceptable? Companies know AI could shape the future economy, but they also know overspending too aggressively could create major financial pressure if returns take longer than expected. That's why many businesses are trying to balance ambition with caution at the same time. And this balancing act extends far beyond tech companies. Retailers are dealing with cautious consumers. Manufacturers are restructuring supply chains. Banks are watching debt risk closely. Media companies are struggling with changing advertising markets. Even large corporations with strong profits are acting more defensive than they did during previous growth periods. There's another important reason stability is becoming more valuable. Consumers themselves are changing. After years of inflation and economic uncertainty, many households are spending more carefully. People are prioritizing essentials, comparing prices more aggressively, reducing unnecessary purchases. Businesses notice this behavior immediately, and when consumer demand becomes less predictable, companies naturally become more cautious too. That creates a chain reaction across the economy. Businesses slow hiring, reduce expansion plans, control inventory more tightly, focus more heavily on operational efficiency, and growth becomes less aggressive overall. But there's also a psychological shift happening on Wall Street. For years, investors celebrated disruption and aggressive expansion almost above everything else. Now many investors are rewarding businesses that appear disciplined, stable, and resilient during uncertainty. That changes corporate behavior quickly because public companies constantly respond to investor expectations. If markets reward efficiency more than aggressive growth, businesses adapt fast, and that's exactly what's happening now. This doesn't mean growth stopped mattering. Far from it. Businesses still need growth to survive long term. But the definition of good growth is changing. Investors increasingly want sustainable growth instead of reckless expansion. Companies are trying to grow while also protecting profits, controlling debt, and reducing vulnerability. That balancing act is becoming one of the biggest challenges in modern business. There's also another hidden factor underneath all this: fear. Many companies are afraid of becoming overextended before the next economic slowdown. Businesses remember what happened during previous periods of instability. Rapid expansion can become dangerous very quickly if conditions weaken unexpectedly. That's why flexibility is becoming one of the most valuable corporate strategies today. Companies want options, adaptable supply chains, lean operations, controlled spending, and business models capable of surviving slower growth environments. Even startup culture is changing. For years, Silicon Valley celebrated growth at all costs. Startups focused heavily on scaling quickly, often without clear paths to profitability. Now investors are demanding financial discipline much earlier. Cash burn matters more, efficiency matters more, profitability matters more. And startup founders are adapting to a world where capital is no longer unlimited. This hidden battle between growth and stability is reshaping nearly every industry. Not because businesses suddenly became less ambitious, but because uncertainty changed the risks surrounding aggressive expansion, and companies are adapting to survive inside a more unstable environment. Some businesses will continue growing aggressively, especially in industries connected to AI, infrastructure, and emerging technologies. But many others are prioritizing resilience instead of maximum speed. Because in today's economy, surviving volatility may be just as important as growing quickly, and that's the real tension businesses are facing now. The challenge is no longer simply how to grow, it's how to grow without becoming fragile at the same time.